Hello, everyone, and welcome to our April investment market update. Today, I'm delighted to be joined by George Salmon, a senior research analyst from Hawksmoor Investment Management. Hi, George. How are you?
I'm all right, thank you very much. Thanks for asking. Yeah, all good.
Good. Right. So we were just having a chat before we started, and we've certainly got some interesting times to be discussing politics and economics and what's been going on in the investment market. So I think you've got some slides for us, haven't you, George?
I do. I can put them on the screen now.
Superb.
That is, excuse me, hopefully coming through onto the
They
display.
are coming
So
through. Yeah, absolutely. Brilliant. So over to
excellent.
you.
Thank you very much. Yes, I'm going to start with the most exciting part, which is the compliance slide, which is very important that we get that in front of our audience. So all the usual disclaimers in there around past performance and how investments can rise and fall over time, and how this information today is presented with both a retail and a professional audience in mind. So with those important disclaimers made clear, I'll move on to my slide. So there is an obvious place to start our discussion, I'm sure you'll agree, which is with this chap and what he's aiming to do across the pond. Um, I thought this was a really interesting chart. I saw this from some research facts that put together, just tracking the mentions of the word tariff in earnings calls. So obviously, whenever companies report to the market, they'll usually put their numbers out together with a call, so analysts can ask questions. And the word tariff is coming up extremely frequently. This is actually probably produced by AI, which is a kind of interesting side note in terms of the practicality for lots of different areas of the market. You know, it's helping the research community itself. But you can see if we go back to the kind of tariffs 1.0, which was the first kind of spike or series of spikes in 2018 or thereabouts. We can see that there was a lot of discussion around that, but this time things are much more intense. Obviously, that's because they're far further or far more far-reaching, I think is the best way to phrase that. Where we've settled on is a kind of 10% across the board. Previously, the main moving parts were in kind of commodities, steel, aluminium, that kind of thing, and a few kind of consumer white goods were front and center, washing machines, that kind of thing as well. But now these tariffs are much more wide-ranging and universal. Clearly, this is important because it will feed through into both economic and company projections. So if we take a tariff for what it is, it's a kind of tax on trade. That tax can either be passed on and paid by the consumer, or it will reduce the profit of the companies in the chain. It will kind of get absorbed by one of them. They're the two choices. The other option is for the transaction not to happen at all. So you'll either get an inflationary impact or a loss of growth. So tariffs are fairly concerning for those reasons. I'm sure you'll all agree. I'll just kind of move on to the next slide here, which illustrates what tariffs have done to the market. So this is the VIX index, the measure of volatility. And as you can see, over, well, this is a 10-year chart, the volatility index is generally a lot lower. There's that big spike around the COVID outbreak. But this is the highest level of vol we've seen over the last decade, apart from COVID. So market clearly reacting with a high degree of trepidation, I think is fair to say.
Yeah, George, it's quite interesting to see that obviously the COVID fear index spike there, but then actually less so for the Ukraine war. It was still obviously a bit of an increase, but certainly more muted than what we've seen recently. So any kind of reasons why that might be?
Um, Yeah, I mean, so Ukraine War, if I'm remembering rightly, would have been the start of 2022, I think.
Yeah.
Um, yes, I mean, there was a lot of other stuff going on around then as well. I would actually say that the most concerning parts or moving parts in the market in early 2022 and maybe through that year, you're testing my memory here, would
Is it more
but that
inflation
would
driven, do
be
you
yeah,
think?
yeah, it would be,
Yeah.
that's exactly right. Yeah. So if I'm right in thinking inflation was well above target before the Fed acted in that time, this will come onto this actually again, or with what Trump's trying to do here. But his criticism of Jerome Powell over the bank holiday weekend around his kind of perceived reluctance to cut rates quickly enough um, is it does have some grounding. I would say the Fed were too slow in early 2022. Excuse me. I also think that if you're looking at the impact on the global economy, clearly there's a knock-on impact on things like European food prices, and we all know the dynamics around the energy market going through Ukraine. But the impact on the US consumer is far greater from tariffs than the outbreak of war in Europe. I would say.
Right.
So yes, I think um, in terms of how the US consumer is feeling at the moment, we can perhaps come back to that in a couple of slides' time. But yes, just to illustrate the extremely high level of vol we have at the moment in the market. Um, it's not just stock markets which are being impacted here. So um, the kind of close trading arrangement between the US and Canada is kind of being impacted by the tariffs. What I've done here is I've got quarterly GDP growth projections and how they've changed over the last what's that, like 6 months or so. So you can see, regardless of which quarter we're looking at here, these are the kind of 4 quarters, um, kind of coming up, and you can see there's been fairly negative revisions to Canadian GDP growth. Um, I would imagine we're probably not at the end of that series of cuts, and this will be a theme that's kind of playing out across the board. As I said a second ago, tariffs are either inflationary or will reduce growth. So not a great kind of backdrop to be thinking about if you're an investor at the moment. So I think we should probably introduce a little ray of sunlight at this juncture, which which this slide does here. Um, Perhaps people in the audience will have seen this before or read about it in the news, but what I've got here is an illustration of how the US's trading relationship is different between the UK, the EU, and China. And you can see the trading position with the EU and China. Far more is imported into the US than is exported. If you use the Americans' own data, it's the boots on the other foot as far as the UK is concerned. So all else being equal, if we had an escalation of tariffs with the UK on both sides, the Americans would be the net loser there. And I think it's fair to say that Trump likes thinking of things with a kind of bipolar. There's a winner and a loser
Yeah.
type narrative, and in that situation, the UK would not be as damaged as the US. Very different as far as China and the EU are concerned. So I think we're nowhere near the end of the tariff negotiations. The relief rally we had the other day was based on a pause rather than a cancellation of the policy. So we'll see what comes around again as we edge closer to that deadline. But I think there is a ray of hope here, which says that if we apply economic rationality, the relationship with the UK should be treated differently than the European and Chinese relationship.
And I guess that was shown to some degree in the original tariffs that were announced, that there was a difference in the tariffs being applied to the UK. Um, and I think we were saying about this a while back. It seems to be he's working from his own book on how to negotiate in these times. But I know you've got some other slides which will explain a little bit more about other stuff. But I think this is a really interesting slide just to see that actually at the moment we're importing more than we're exporting. I presume that's what that's suggesting there.
Yes,
Yeah.
as I say, yeah, the relationship is clearly different with China and the EU. Hence why they were
Mm,
the kind of first in the firing line, if you like.
sure.
But yeah, let's just have a look at potentially why this is happening. I think there's so many different narratives that you can spin here in terms of Trump trying to maybe uh, fire up support in areas like Pittsburgh or cities like Detroit, that kind of thing. Um, Maybe across the Rust Belt areas where Americans have been kind of left behind, and these are the people who are buying into his politics at the margin anyway. These are the reasons he's got elected is make America great again, America first, all these kind of narratives. Um, and if you particularly kind of couple his comments around Jay Powell over the weekend or the long bank holiday weekend, around his, as I said a second ago, his perceived reluctance to cut rates quickly enough. One can make a case that if you're going to kind of try and get try and get rates down, and you're not a voting member of the Fed, and you don't have autonomy over the chair of the Federal Reserve. Um, how else can you do that? Well, economically speaking, one way is to kind of cause a bit of pain, and if you can do that pain in a way that's going to be thought of um, positively by your kind of key voting groups, that's one way you could go about it. The problem with that is that it just didn't work. So originally, this is the 10-year yield on US debt. 10-year what came down a bit, and then markets had a tantrum, and it's in my opinion no coincidence that very shortly after that spike in bond yields, Trump walked away from the policy.
So
Um,
do you think it was majoritively down to the bond yield increase rather than the value of equities in the market? So if we're talking about sort of values of companies, had the bond markets not reacted this way, do you think he would have carried on for longer? And is this the classic, the bond vigilantes, which we saw playing during the UK issue with Liz Truss, basically showing again here that if you're going to keep pushing this envelope, so to speak, go down this direction, we're going to show you the net effect it's going to have, which basically means the cost of borrowing is just going to become unsustainable for an economy, which then would actually put the underlying economy at risk rather than just trying to have a bit of a trade war.
yeah, well, there's a lot to get my teeth into there, so let's try and approach that sequentially. So first question, do I think the move in the bond market was more important than the move in the equity market? The simple answer there is yes. I think the example you gave around Trump, sorry, around Truss, get my politicians mixed up. I mean, the kind of bond market has is notorious for its ability to step in. So I popped the quote from James Carville, who's I think he worked with Clinton, who's a strategist anyway in around the turn of the century. Basically saying when I die, I want to come back to the bond market so I can. That's how you really scare people. And I think the bond market, yes, I think that dominated over the equity market. I don't think that the equity market was something that he would have enjoyed seeing fall,
Mm-hmm.
but I think that the bond market was the more significant fall. Hence the inclusion of this chart here.
Yeah, yeah.
So, so yeah, I think the point I'm trying to emphasize here is that I think the bond market is, yes, I think that's that's the deciding factor in the kind of pausing of the tariff imposition. Sorry, what was your second question?
It
I've
was
had
really, yeah, just about tariffs. Well, the impact obviously of tariffs, but it's more to do with the bonds and how has that had more of an impact than equities? And do you think he would have allowed equities to have gone further down had the bond market not intervened?
is a incredibly difficult question.
Don't worry, it's one of those. It's
I'm not
just,
sure. I don't
yeah.
want to kind of I don't want to kind of get too far into if buts and maybes, but yes, what I will say is, as I said a second ago, I think that the bond market is the more important move.
Mm,
Equity markets, in fact, well, I've got a nice slide on this actually in a moment, so we'll just move through. But I think this is why I'm giving the answer that I'm giving. So if you look at the numbers around the US debt pile, um, which is a really eye-opening experience, actually. And I'm not convinced that the human brain is built to understand numbers this big. Um, but the US is going to breach $1 trillion in interest payments pretty soon. I can't tell you exactly when because it'll depend on various auctions and that kind of thing. But within the next couple of years, the US will be spending $1 trillion a year on servicing its debt. That is not the debt value, that's the value of the interest cost per annum. And I've put on the slide here a couple of things to put that in perspective because I do think the numbers that bid need to be put in perspective. Um, that's about 3% of American GDP. If it was a economy, so if servicing the US debt was a global economy, it's pretty close to being in the G20. So yeah, pretty pretty difficult.
I think that's
So
crazy in its own right, isn't it? That's to kind of highlight the scale
yeah,
and just sheer size
yes,
of that debt.
and that's why the bond market is particularly pressing
Mm,
for someone like Trump, because obviously he needs to be aware of the kind of debt servicing position. If we just compare this to the UK, I think this is really important actually, because I put the tariffs in perspective or the UK's position there. Clearly, the UK has a much higher debt and debt ratio than it has done historically. We're kind of in a new normal of higher ratios there. One of the key differences between us and the Americans is that our debt um, is spread over a larger range of maturities. So the Americans tend to have um, debt that's kind of a small number of years and then you roll it over again, and they refinance a great portion of their debt on an annual basis, which means when you do get an interest rate shock, like when rates climbed up over the last couple of years, um, you get this kind of issue of refinancing much quicker. So the UK position, we've got a lot of debt that's kind of locked in at lower prices. Think of this as like we've got a longer term mortgage with a lower coupon attached or a lower interest rate attached. The Americans have an awful lot of debt maturing in the next 12 months, and doing so at more expensive coupons is very significant. Hence, this $1 trillion issue of servicing the debt. So that's why I think that the bond market is particularly scary to Trump.
sure.
Um, so yeah, so bonds, scary bonds. I should just put this all into context. Um, Here is a chart of American GDP by president or presidential term, I think it is, color coded appropriately. And you can see that over the last, let's call it 100 years, or nigh on 100 years, um, generally speaking, we've had pretty consistent growth. This is not the first crisis that America's ever had. If we look at any particular decade in there, I'm sure you'll be able to kind of cite various examples of financial crises or debt ceiling crises, wars, inflation, energy crisis, whatever. The Americans are very good at coping with these things, and I think we'll maybe talk a little bit about relative valuation in different geographies. But if we're talking about a capitalist society, um, there's a reason why nearly all of the biggest companies in the world are American, and almost all of those businesses we can think about the tech giants as a good example. Google, Microsoft, Amazon, Tesla, Netflix. The list goes on. They're pretty young, so these are young, dynamic, powerful businesses, and I think that to write off America over a long period of time is a dangerous thing to do. I think you can make a strong case for valuation being high or low in any particular year, but if you're talking about a long holding period for equities, which you should be, um, I think I still think it's got a very strong culture behind it, the American equity culture. Um, so yeah, there's um, the long-term record of the American economy. Um, I should say at this juncture, I probably should introduce myself and give a bit more about my day to day. But my day to day responsibilities are basically looking at companies individually. Obviously, I deal with the macro as well, but I will read an awfully large number of company results and dial into those aforementioned calls. And I think that this is a really, really good way of getting knowledge about the wider macro. I think, like for example, I pulled out what's this, 5 companies that are due to report in the next week or two, and what they'll be able to tell us about what's going on out there. So, Visa will be able to tell us an awful lot about consumer strength. Spirax Sarco, they'll give us a good indication of industrial activity. We've got Lloyd's, WPP, Microsoft. These are leading businesses in the sectors they're operating in, and they've got absolutely huge quantities of data, particularly the likes of Visa. You think about how many card payments they process; they've got a fantastic picture of consumer confidence. I think it'll be really interesting to see what they tell us, because the bar for consumer confidence, particularly in America, has been lowered quite a lot in the last couple of months. So I think there's a lot we can learn from this particular reporting season.
It can be very interesting, isn't it, to see?
It will be, yes. And I've just got a couple of quotes from what we've seen so far. LVMH, Next, BlackRock, JP Morgan. Don't need to explain who these guys are. I think the comments from Next around the UK are particularly interesting, because spending has held up fairly well, and they're a business that's been operating um, at or above expectations for a fair while. But they kind of flag some increases that we've had in April around tax changes, and also they talked about some kind of inflationary impacts, i.e., things like mobile contracts or TV deals, these kind of things. All of these inflationary things, water bill increases, this kind of thing, are all kind of coming through pretty much now, and it's not quite right to extrapolate what we've seen in the first bit of the year into later in the year. I think Next are absolutely right to do that. The one I'll just kind of put the most credence behind is the JP Morgan quote. Um, so I mentioned that we can learn a lot from how companies, um, what companies can tell us and the value of the information they have. JP Morgan is headed up by Jamie Dimon, who's been there for I don't know how long now, but did a very good job around the financial crisis. And I'll just give you 2 examples of things that he said um, in the last couple of years. So he was on record in 2021, possibly 2020, actually, maybe the end of 2020, saying he wouldn't touch US Treasuries with a barge pole. However many months after that, we had a banking crisis in America, which was caused by exactly the issue he predicted. It was the balance sheets of the banks that got into trouble were packed with surprise, surprise, US Treasuries. And then more recently than that, he talked at the full year results stage. I think it was in February. It might have been January. earlier this year anyway, about how equity markets were perhaps a bit high, and putting uh, less money into a buyback was the right thing for JP Morgan shareholders. I'm not saying that he knows absolutely every time what's going on, but again, surprise, surprise, we've seen an equity market sell-off. So I think there's a lot of reasons to listen to what this guy says, and I think his assertion that we're gonna have a lot of companies remove guidance, um, I think is particularly interesting for equity markets, because analysts don't like that.
No.
Analysts just do not want people to be removing guidance, because it means that there's a wider possible range of possibilities, and that's something we've seen with the tariff situation. And again, I will come back to a more positive stance on this, but something that happens when there's a big change of uncertainty. Generally speaking, analysts will assume the worst, and you'll get a lot of modelling being revised down to kind of worst case scenarios, and that will cause a lot of the volatility. So I think that if companies do remove guidance as he expects, and I also believe, I'm not sure that there'll be a particularly positive reaction to that in the immediate term. Um,
And I think that's an interesting point, isn't it? It's about, I've always talked about knee-jerk reactions, which sometimes happen in these situations. So there'll be information that comes out, there'll be something that happens that basically means, because there is not necessarily a known outcome or where it will end, sometimes markets will drop faster and quicker and deeper than they otherwise might do, and then you do tend to see maybe a settling down over time. So we are in uncharted territories to some degree. We've obviously seen what's happened before with tariffs, and you said that was obviously a very different situation with the type of areas that the tariffs applied. But obviously, this will give you a bit of an indication of just the market still feeling a little bit uncertain as to what's actually happening and what the end result will be. But fingers crossed, that things will settle down, and trade deals will be worked out. And
yeah.
a bit like we saw with, interest rates coming down last year and just seeing some movement, all of a sudden the markets are almost sat there poised, waiting for that positive news to come back, and just to get back in and start seeing some future values return. So yeah, quite interesting. And I think you've got, is it your next slide, the one that's a bit more,
No, I've got one more doom and gloom.
one more doom and
I
gloom,
will. I will just say that
right?
I think you're absolutely right. The idea that markets can only react negatively to news is complete nonsense. I'm not sure of the exact number now, but certainly high single digit movements at least, when the tariff kind of concerns were lessened, and that delay was put in. There is potential for being out of the market can be very damaging. When we're in conditions like this, because you will by definition miss out on the upside as and when it comes around. And do I think there will be a situation where the White House is happy that to have indefinite uncertainty for its economy and for the rest of the world around tariffs? No, I think that's ridiculous. There will be agreements reached. I can't tell you when, but as and when they're reached, that certainty alone should be enough to give markets a rise. It's just whether we'll see a bit more turbulence in the near term.
Because fundamentally, the economies are relatively stable, companies are in reasonable positions. So, obviously, if this carries on, then that could have a more of a longer term impact on them. But
Yeah.
reality is, we were seeing growth, weren't we? Things were moving in the right direction. So
Oh
this is
yeah,
a
yeah.
this is
So
maybe a
earnings.
deviation, perhaps, for the time
Yeah,
being.
absolutely. I mean, the aggregate earnings that are going to be reported in Q1, which is the numbers that are coming through in the next week or so, there'll be a glut of results. On average, there will be earnings growth
Yeah,
compared to last year. Yeah, we are still in an expansionary cycle as far as corporate earnings are concerned, at least.
yeah.
Um, we need to keep things in perspective. Excuse me. I do think that perhaps earnings are a bit high, for where we are. So this is a graph of how earnings have evolved, um, for 2026, so next year. You can see there's been a bit of a revision down over the latter half of 2024, but so far this year we haven't really seen much in the way of analysts moving their numbers for next year down. And I think if we just go back to the comments that we're seeing here around uncertainty and a difficult environment, I think as and when companies release more of those type of comments, and as potentially guidance is removed, I do think that we might see some negative revisions to earnings. That said, we've already had revisions to share prices. So where that ratio stabilizes is the important thing. And I think that, you know, if we're looking at one of the points you mentioned there around the stability of companies, this is really a crucial point actually. Um, an awful lot of businesses out there, whether it's in the UK, Europe, or America, which are the markets I generally cover, but you know, I'm sure it's correct across the rest of the world as well. Um, balance sheets are in pretty good nick. Profit margins are pretty high, and we've got a fair amount of wiggle room before there's, you know, kind of serious issues for in the main. Obviously, there will be isolated examples. So one particular sector I can think of that would be a good case study for that, or maybe two, would be the banks. The banks are far better capitalized and managed now, post-crisis, and we saw that with the lack of contagion around the small and mid US banking issue that I described a minute ago with the JPM comment, and also the house builders. So around the financial crisis, the house builders were running lots of debt. Now they're running net cash positions. That has helped them be a lot more stable in a very difficult environment. So I think it is fair to say that companies have learned lessons um, from previous trials and tribulations. And you are quite right; companies are in pretty good financial shape. So they can't control everything, but a lot of the controllables they can control, they're doing so pretty well, in my opinion.
Right.
I'll just move on to I said there was one more.
Yeah, we've
So
got
so
a
good. So I think this is quite interesting actually. And this comes back to the volatility that I was describing earlier. So this is a longer term vol chart, and it's got the MSCI world on there as well. Not a total return chart, just a simple price chart. Um, and something you'll notice here is that when volatility spikes, it's pretty common for the subsequent returns from that starting point to be supernormal. So if we just look at this 30-year chart, the average price return, i.e., before dividends, is in the region of 7.5% for MSCI World. So that's, you know, call that the global market. If you just take the starting points where volatility is in excess of 30, those average returns are more like 19%. Okay. And that's not just a couple of data points. This is weekly data going back over 30 years. There's 135 data points where the VIX has been over 30. So I think at this point I should say that this is absolutely not me saying, well, don't worry, guys, you know, we're going to have supernormal returns for the next 12 months. But it is me saying that when volatility happens, if I think it's, you know, this ties together quite nicely actually. If you kind of run away and say, okay, I'm going to come back at a later date, it's you are risking missing out on that upside as and when it happens. And history tells us there's a reasonable chance of upside coming at a time where you would be at the market if you sell on fear. So, you know, I think the contrarian in me is absolutely taken by that argument. But I should say that there's absolutely no way we should join the dots and say that that is um, something that we should kind of extrapolate from the past and indicate future performance.
No, absolutely. There's never any guarantees, is there? But
Correct.
you know, you do have to look at trends. You do need to consider what's historically happened, the positioning of the current world economy, and I think you're right. It's really highlighting the fact that we just don't know when the markets will turn, how they will turn, but
Correct.
historically, when they've turned quickly.
They can turn quick.
And
That's exactly it.
it's
Yeah.
that classic that you have to unfortunately get comfortable to some degree with being uncomfortable at certain times through your investment journey. And as long as your planning's been correct, then you have the ability to ride through those tougher times. So
I wish I had it on the slide actually, but there's a wonderful bit of work that's been done around if you missed the 10 best trading days
yep,
in the last 20 years. I'm sure you're familiar with this, and I'm
yeah,
sure you would have seen this before. But yeah, if you take a 20-year trading record and remove just the best 10 days, your returns are nowhere near as high.
no,
Um, and you've only removed a very, very small number of days because there is positive volatility possible as well.
absolutely.
I should just say, actually, just kind of joining this together, I would say we're definitely not out of the woods. There's still quite a lot of uncertainty around, and as and when there's clarity from the White House on tariffs and trading and one or two other things, I think that'll be very, very well received. In the meantime, I think that we should remain focused on key principles like relative valuation. I think that's always a great starting block to build an investment case. And then beyond that, I've mentioned some companies that I think have leadership that are worth listening to. I'm not saying that they're fantastic investments, but I think the strategy of the management team is incredibly important in these type of environments. Good balance sheets, these kind of safety first type criteria
Mm,
are really where I'd be focused now, more than ever, really.
brilliant.
So yeah, I think they're the criteria I would really look to seek out at the moment. And for anyone who's watching this at the start of your career, I think there's a lot of lessons that can be learned here. There's the great Warren Buffett comments around you only see who's swimming naked when the tide goes out. Um, there's
Indeed.
possibilities for that to be happening now. So we will learn a lot about the relative strength of companies, the relative um, aptitude of fund managers in these uncertain times. So there's a lot of things that we can learn and take from any volatility.
Right. Well, listen, George, we're going to leave it there. Thank you ever so much for your time today. Really appreciate your insights and for your time and the presentation. Good to see you.
Yeah, good to chat. Thank you very much.
Thanks.